Hey everybody, Preston Bryn here with our Trader User Group Weekly Roundup. This is for the trading week ending February 24th, 2017. What I have on the screen here is a really interesting chart, a 15-minute chart of the Dow futures. And the markets this week have been really amazing. And like a photo finish in a horse race with only a couple of minutes to go before the markets closed on Friday. The Dow was in the red. The Dow Index was in the red by about 10 points. And it looked like its 10 session high closes, 10 consecutive sessions of high closes was finally coming to an end. But I mean, literally in the last 120 seconds of the day, traders and buyers came in and actually lifted the Dow into the green, giving us 11 consecutive winning trades finishing in the green. This is the longest record since January, going all the way back to January 1987 when the Dow had 12 consecutive closes, record high closes. But of course, we all remember what happened in 1987 because in October of 1987, October 19th to be exact, we had an event called Black Monday, and that's when the Dow fell over 22% in a single session. Now, that's a single session, folks. That's not over a month or a year, but in one day. So, but getting back to the chart I have here on the screen, I just wanted to start it off with this because you can see right here around 3:15 in the afternoon, I use a 520 moving average over my volume because it works just as well as it does over on the index itself. But you can see here the 5 crossed the 20 moving average on this 15-minute bar chart. So this shows you just in a very short time frame what we did for the day. You can see that, you know, going into right at morning's open, volume started actually coming in and it really started moving up, and we had this move up like this, and then we kind of drifted during the day, and you can see volume just kind of came out. But then as we come into close and it looked like we're going to break the or stop the win streak, all of a sudden volume just came in and shot up in the last few minutes of the day. And this is the Dow futures, but in the index it did the same thing, of course, and we closed for our 11th consecutive win, which gave us a record that really goes all the way back. It goes all the way back, as I said, to January 1987. Really amazing. Now, if we come back over and let's take a look at the E-minis. Let me just, what did I do here? Let's see here. Okay. I think I hit the wrong button, so everything went black. No, the world's not coming to an end. That was really amazing. That's what you get when you have a lot of screens on your desktop. But anyway, going back to the E-minis, if we look at the E-minis, you're going to see the same thing, the exact same pattern. By the way, this was the pattern that found itself across all indexes, right? We had the situation where, you know, we started the day, the volume took off, we had that move up, then we had a sideways pattern like that, and then we just finished with a bang and a flurry here in the end. You can see the volume actually was stronger at the end than at the beginning, just to move the indexes higher like this. So we had the only major index on Friday that closed in the red, and that was just barely, was the Russell. Now the Russell has been kind of trailing the entire year, but this does show that sometimes traders can play their reindeer games and then just boost the price up into a record close like this and a record finish. Now, just as another stat that I'll throw out at you guys, you know, this advance that we've had in the Dow over the past 11 sessions has amounted to about a 3.8% move higher. But if you look at all these consecutive sessions in history that have had, you know, 8 or more consecutive winning sessions, this one has been one of the weakest, which kind of goes back to my theory and what I've been talking about here. It is a grind higher. There's not a lot of new net longs coming into this position here, given the market where it's sitting right now. And you've got to understand, markets and market sentiment remains very frothy right now. We've got you know, when you typically get a sub 12 VIX or volatility, you've got 18, you got an 18 reading on the forward multiples. And there, a recent Investors Intelligence report where it came out showed there's 60% of the investors are bullish and 40% bearish. And you compare those three items with historical standards, it does tend to show that there's a lot of limited upside potential here over the next 6 months. Now, if we come in, and let me just get this back here, and I am going to clear the screen for just 1 second, get all of these major indicators off. You can see here that we've had this huge run over the past, or since February, right? I mean, we were here and we were in this tight range here like this, and we were in an overall tight range like this right here. And we came down and tested this prior range, and then we just shot up about the second week in February, and we haven't looked back. I think a lot of this is going to be given up, taking us right back down to around the 2300 level, which is the key Fibonacci extension of prior major pivot point highs and lows. And I can't tell you when this is going to happen, but I suspect we're very vulnerable to that. But I also have said to our members that we are definitely a buy in the dip area right now. And for a lot of our members that are following us on Secret Trader, we're already 10 for 10 in the trades that we've opened and shut down since January the 9th is when we started the 2017 year. If you're not in our Secret Trader group or you want to become a user, I highly encourage you to check out the offers that you got on this email leading you to this webinar here. But anyway, we've got this move here, and I do believe that we've got better than a 50% opportunity or chance of coming back to 2300, but you're going to see buyers probably come back in and step in somewhere around that level. Okay, now I've been seeing the press come out with these terms. We're seeing terms, you've probably no doubt seen the financial press come out with the term reflation, which is really the idea of moving more as the economy moves, the U.S. economy moves more towards a fiscal versus a monetary policy theme. Monetary policy theme is essentially where you've got the feds running the markets, and that's what we've had since 2008, really, going into 2008, 2009 crash. Started in the summer of 2007. So we've had about a 10-year run of monetary policy, and you guys probably heard over the past 2 years, Yellen, who we call AKA Aunt B, coming out and saying she needs more fiscal participation. Monetary policy can't do it alone. So this reflation idea is the fact that we're moving more towards fiscal, that Trump is pushing, where he wants to light the inflation fuse, basically, by lowering taxes, dramatically reducing regulation, which will get the small and mid-sized companies moving even stronger than large cap companies, and more about infrastructure build out. So that is the reflation term that you're probably hearing over and over, but that's what it means. So this is kind of where we're looking at the markets right now. I do believe a pullback. Again, our trades are set such that if we have a pullback, we're actually going to make money, even though we're bullish. And you can see this right here. There is absolutely zero bed in that indicator. What do I mean by bed? That's bearish divergence. That suggests that any pullback more than likely is going to get bought. Now, how far back will that pullback go? It depends on these key levels that we're going to participate in, right? And I don't see the pullback personally going lower than the 2300 at this time. And of course, that's just, you know, when you, as you guys all know, we trade this side of the chart. This side of the chart we use to analyze what the hell is going to happen on this side of the chart. And based on, and all we're looking for is an edge. Anywhere, we're looking for about a 55% plus edge, right? And it's not just looking at an individual chart, but we always start with the indexes first. And then we work our way down to sectors. We look at the major commodity groups, or what I call the food groups, and we look and see where everything is. So this is kind of, and then it forms a pattern, it forms a picture, and then we can it gives us this edge of 55 plus percent. It's called market awareness. It's called being aware of where you are in things instead of just trading into one individual stock. We like to look and see, are we in a buy on a dip, or are we a sell in the rally? Where is volatility, low, high? What is the bond market doing? What's gold doing? What's the US dollar doing? How is it forecasting this stuff? And then what do we have coming up here to really talk about all this? So, all of these market gains that you're seeing here have come on the heels of the Feds, led by Yellen, or as we finally call her, Aunt B, suggesting at least 3 rate hikes coming up for the year. And by the way, the markets have only forecasted 2 of these things, but they've got a meeting coming up on March 14th and 15th. It's a quarterly meeting, so Aunt B is going to step in front of the podium, and she's going to give us her recipe again for blueberry pie. And let's see if it's full of sugar and fat, or and very sweet to the taste, or is it going to be tart and bitter? I suspect she is going to be, if they don't hike the rates in March, which the 30-day Fed Fund futures is forecasting about a 40% chance they hike the rates. I suspect that pretty much puts everybody on record that they're going to hike the rates at the next quarterly meeting. And why quarterly meeting? Because those are the ones where Yellen does her press conference. Now, we've seen the Feds hike rates in between quarters, but I just don't see her doing that. She's not that kind of Fed chairman. She's very dovish, meaning she likes to serve blueberry pie, very sweet and full of butter and very tasty. The market's like that. So this is kind of where we're looking right now. So I'm putting all the indicators back on the screen here that I have, but this is where we're looking. You can also see we have a huge and strong volume over price support level right in this area here. You can see the volume coming way out to this level here, and it's almost sitting right on our 38% fib extension here at 2263. I mean, almost to the T. So this is, the first level of support is going to be this thin band here around 2300. Okay, should we break that, I'm going to look to see that this wider band here holds up, starting around 2280, taking us down to about 2260. And even pulling back here is nothing in the scheme of things, guys. It really is nothing. And just to show you this again from another perspective, let me just take all the indicators off the screen here. And then I will come in here and I will just choose a percent move, and we'll come from the high here. And a 1% move doesn't even show up on and we haven't had a 1% move in a while. About a 1% move from the all-time highs here takes us down a little over, I did 24.5, but it would really be about 23.65, but it takes us right down to that fib extension here, which to me is very believable, right? That's a 1% move. In the scheme of things, it amounts to nothing. If I do another 1% move, again from the all-time highs, let me just mark it up here again, and let's do another one on the chart here just to give you guys an idea where it comes from. And let's come down to the 2300 level right there. That to me is another good touch point, about 2.8% down move, which is about 66 points. Now, I know a lot of you haven't seen a down move in quite some time, and when you do, it's like 2 or 3 points, and then the next day we make it right back up and then some, and we keep our grind higher. I'm not sure what a lot of people are going to do when we have 2 or 3 red bars in a row, or red days in a row when we go down, but even a 2.82% down move takes us back to the area where I think is the most logical near-term stopping point on a buy the dip kind of mode. You'll see buyers start to come in at this point. And then finally, if we take us down to the very next level, the one that I had talked about before, which takes us right down into this area here. Let's come back down to right in that area, right about there. Right in this range here, about a 5% move down. So these are the scenarios that I see. I don't see anything much worse than this, okay? And obviously no man in his right mind can tell you, well, this is what's going to happen right here, and these guys aren't going to happen. We're going to go down 2.82% roughly. You know, that's crap, and you guys know it. Once a down move starts, we've got a lot of shorts in the market. We're getting some of this run up is covering shorts, of course, because I've got friends that are still short this market, and they're screaming and yelling all the way up. They stay short. We trade where the price action tells us, no matter what your logic tells you. You know, and that reminds me, I saw an article in Barron's this weekend, and it talked about the Dunning-Kruger effect. And the Dunning-Kruger effect, the writer accurately posits, it's basically says that less competent people tend to overestimate their proficiency, while highly competent people tend to underestimate their skill. And in trader speak, basically what that means is those experienced traders, meaning you've been around for a while and you know what you're doing, tend to work more on risk mitigation than you do profit maximization. And this is one of the tenets of our user group when I formed this group in 2008, believe it or not. And we worked on risk management. How can we make money yet manage risk? And that's the whole goal and why we've been successful and why people like what we do, because it's all about risk management. You never see emails come across your inbox that tell you, sign up for this webinar, we're going to talk about managing risk. Sign up for this webinar, we're going to talk about how you can mitigate and hedge your downside and ways to manage risk. You just don't do that because it does not sell. Most people, especially new traders, are what I call rat brain traders, which basically they feed off the sugar, the Aunt B, you know, free money for everybody kind of syndrome, which basically says you get the emails that say, learn this new blue moon strategy that we call the triple Lindy double loop back somersault flip, and you'll make 100% every 3 months or 100% every month. And no one really sits down to really think about what that writer or what they're trying to pitch to you, which is, you know, if they could make 100% every 2 or 3 months, they don't need anybody else. They could retire literally in 2 or 3 years with billions of dollars. But that's not how the game works. They know that rat brain traders out there feast on that, and it does not work. So what we work on is managing, right, our risk management. And when we've been in these prolonged up moves, we've got a number of scenarios. And when we pick a scenario, whether it's 1, 2, 3, or, you know, a big down move, you know, which takes us down to these levels down here, which is a lot, you know, down to the 10%, 15% level. You know, how do you mitigate that? What happens if you wake up on a Monday and China has basically did what they did in August 21st, 2015, where the VIX had the largest percentage move in a 4-day history in the history of VIX, right? And volatility. Remember, volatility we've seen the VIX up in the 80 and 90 area. And on that day, VIX only moved up to 52, but it went from like 11.5 to 52 VIX in literally 3 or 4 days. It was the largest percentage move in the shortest period of time. How do you guard against something like that? Because nobody can predict that, because by definition, a black swan is an unknown event. If they tell you this event can happen, then we call it in our group a binary event, and we can trade binary events like the Brexit vote that we traded at 2 o'clock in the morning, New York City time, or the Trump Hillary Clinton vote that we traded again at 2 or 3 in the morning. Our members were up and we were making good money on that trade, great money, because you don't know how price action is going to react until it reacts. Everybody got it wrong. Forecasters, traders, everybody thought that if X happened, then Y would happen in the price. And it didn't. It did just the opposite. And what we do and what I propose and what we do here in our group is not that. We read the tea leaves, and in the tea leaves suggest, you know, hey, you know, you see the rain clouds, you see the drops on the window, you hear the thunder and lightning, you can smell the rain coming, you can see it coming. So guess what? You might want to get your umbrella out. Now maybe it blows over and it doesn't rain, but we look at what's going to happen and we play that. We never try and guess. I guess the accurate term would be we don't anticipate trends and trade in front of them. We let the trend happen and then we trade on top of them. Okay, and you'll see over a longer period of time, it's the only way to really trade and build your account. So anyway, this is kind of what I'm looking at in this market right here, and these are the potential pullback points that I would highlight to you. Now we could do the same thing, and I can spend a lot more time doing the same thing in the Dow, the NASDAQ, and the Russell, but I'm not going to do that. I will show you that if we do look at the NASDAQ, which has been the strongest index, which has just been, you know, on a tear to the upside, you can see, I mean, if you look at this, here's the 2017 open price of NASDAQ right here, right at about 48.78. And then we've just been this year just straight up like that. If I take everything off the screen, I mean, this is just truly amazing. And you can see here on the NASDAQ, as we've been making new highs, higher lows, which is the classic definition of a trend, right? Of an uptrend. You can see here in the MACD, absolutely zero. And I can't point this out any better. There are zero beds, bearish divergences. Again, any pullback is probably going to be bought. And then measuring the degree of the pullback, I think we're in this buy on the dip kind of mode. And we're going to be here until we work ourselves out with, can the markets move higher or are the markets going to roll over? Keep in mind that anything can stop this move up. I've always noticed on TV, the talking heads on TV, and it doesn't matter what business channel they're on, they always have a reason, and the financial press always has a reason for why the markets do what they do. I laugh at it because it's like human nature is to try and find a reason why the markets went down today, or a reason why the markets went up yesterday, or whatever. And you can always find something in the news that can explain a down move and an up move. Now, at the end of the day, is that the reason? Maybe not. Remember, the market is nothing more than a collection of millions and millions and millions of individual investors or investor groups and funds and money displaying fear and greed and risk and everything else, and just money flow. So any one day means absolutely nothing. You generally need to look at trends to see where money is going. Now, the interesting thing on that, if we look at volatility, and we take a look at the VIX. Now, the VIX closed Friday down, and you can see here we had a little bit of a pop-up with the markets opening down, and then we're coming right back down again. We're in this green sector on the VIX chart. I color code by sectors on the VIX because each sector generally implies a different option strategy that you want to use. It's not hard and fast, but it's enough to keep you out of trouble, right? And you can see these zones or sectors, and you can see zone 5, which is what I call black swan, which is anytime we get over a 50 VIX, right? And you can see here, you know, how where we're sitting here. Now, one thing, which is a little bit of a myth, the VIX can stay underneath 15 for a very long period of time. And then it's offset by these volatile moments where it shoots up in zone 2 and zone 3 very quickly, and then we're back down again. You know, of course, this shoot up here was leading up to the U.S. elections, right? So that was one shoot up there, and then after Trump was elected, you can see what happened. The VIX has been back in the green, and we haven't moved out since, okay? And if we go back in time to the last pop-up, the big one was the Brexit vote in Great Britain, right? These were binary events that were forecasted, and these were more tradable, which is why we traded them, because it was a binary event that you could play, okay? So these were things that were known knowns, not unknown unknowns, and we just took them and we played with them. Now we're back down in this area again, so we're subject to spikes to the upside, but just as a note, we can stay down longer than you think. But let's look at the bond market. The bond market is also telling us something. Let me just put this up here. The bonds had a very strong finish on Friday. And let me just widen this chart out for you guys here, just so that you can see something. And let's move it right here. I'm going to block in the year 2017. So if I take 2017, which is really right here, that's 2017. You can see we entered 2017 right in that area right there. That's kind of where the bond market came in. But it really started the second week in December. The bond market started moving up. But we hit it on an upswing coming into the new year. We continued it. We came down and made a higher low from the December low. And now we're trying to break out like this. We're making consecutive runs here. So the bond market now is right at this level here, which is obviously higher than this level here. You can see the 2017 open price at 150 and the bond market finished at 153.07. So the bond market is basically saying, you know, and money traditionally flies into the bond market for a number of reasons. One of the things that has confused investors is why have bonds been up when the equity market was running up? And a lot of that was because of money, and we've talked about this 6 months ago, coming into the U.S. bond market from Europe and from Japan. And one of the things that we've seen that was very interesting is even though the bond market is climbing and driving down the interest rate yields here, and by the way, gold's also moving higher along with U.S. equities. So rising gold prices and rising bond prices and lower yields, the market is starting to send out another yellow flag here to say be wary. Short-term notes over in Germany, their 2-year yields have now gone back below zero again. Hence, there is money coming into the U.S. bond market, all right, because interest rates, they're much higher than zero. And we've seen this for 4 or 5 years when Yellen was driving our rates down to zero, you know, or kept them at zero. So there's still a lot of money coming in from Europe. And the reason why the German short-term yields are falling is because they've got elections coming across Europe. Again, another yellow flag. We've got the Netherlands coming up very soon, and we got Italy, France, Germany. Populism is rising there, and should any one of those countries, populist political leaders win, they're going to put a vote up for that country to get out of the ECB. That would all but tank the euro. So we're getting money coming from Europe again into the bond market, so that's a big part of it. And we've experienced this before. If and when, let's say, populism does not win in Europe, and each country that wins, or let's say each country where the populism loses, and they they're going to stay in, you're going to see the bond market roll back over again, money come out of the bond market and start flowing back over to Europe again. So this is part of what's driving this thing here. But this is just an early warning flag to say beware, because if any of this does come to pass, you're going to see bonds really jam up to the 200 EMA, back up around the 157 area. Interest rates go lower. Gold continue to press higher. And it's going to be a really interesting market environment. Volatility is also going to go up as well. Okay, so that's kind of where we're sitting there. And I spoke about gold. Here's gold. Look at gold. Again, I will block out January, the year January. This is where we are right now. And you can see we entered the year right here at the lower part of the box, and now we're at the upper part of the box. Now we're following this channel to the upside. And again, just like the bond market, gold and bonds are correlated very highly right now, okay? And even though the equities, as you guys know, have had a very strong start to this year compared to 2016, then you may say, well, why is gold up if equities are up? Because right now there's no sign of inflation and there's still some underlying fear in the market. And gold had this key test of the 200 EMA. We couldn't break it here. We couldn't break it here. When we finally broke it here, we did the requisite retest. We didn't really have a close very long below the 200 EMA, and now we've come back up and we took out the prior pivot high. So the gold market is just running this classic move here. Higher highs, right, and higher lows. It's classic. And even given the move in the markets here, I would say the bed is almost flat, right? Not quite flat, but close enough to say that buyers are still willing to step in on any dips in the gold market. Now, the lower part of this channel, or the 200 EMA, is going to provide support for it, and we're going to watch this thing, the odds favor it to run higher. Okay, and then of course, if we look at oil, we've had a couple of successful trades in oil. We look to have more. Same with gold. You can see here. Let me just move it down so you can see my chart here. You can see the 2017 open price. We're slightly below that. There's a 2017 high price for oil. We're in this wide range, right? And that's what we're trading in oil futures. And you can just see this is the box that we're in. Eventually, we're going to break out of this box, but I tend to be a little bit more of a contrarian guy. I believe the breakout of this box is going to happen down in this area here. Should we come out and make new 2017 highs, I want to watch the counter reaction and the counter test, which we will probably have. If it fails and come back in here again, then I'm just going to add, possibly some more shorts up in this area. The first test is this red line, which is the 50 EMA, because it's got an upward trajectory on it. Same thing with the 200. We've got a wide separation between the two. Right now, oil has been in a little bit of a bullish mode, but it's been basically from the bottom of this trading range to the upper part of this trading range. I've always said for 2017, I don't see oil getting up much more than $58 a barrel. It may touch 60, but I just don't see it. And then I call the bottom end of the range around $47 a barrel. So I've defined kind of a classic range for oil. So this is how we're setting up our trades in the option market for this. So that's working out fairly nicely for us. And then we've got some things going in the ag market. Haven't done anything in meats this year, but we're going to set up some stuff. Other things in the soft market. So it's a real interesting market that we're playing, guys. I just wanted to go over some of these key attributes for you. The other thing that I forgot to mention, we've had 48 sessions, not days, but sessions, which is almost over a couple of months. I mean, really, where the S&P's traded within a tight 1% range. We haven't seen a 1% pullback in like 90 plus days. So we've got a lot of quiet stillness and calmness in the markets, given all the landscape that I've talked about coming up. So again, you've got to mitigate the risk to the downside. Now, one interesting thing also this week, we got the Snapchat IPO coming up. I think it's going to come out around $14 or $15, $16 a share or something like that. A lot of people are banking on it's going to be like another Facebook, because Facebook's tripled since they've gone public. They're at like $138 a share or something like that. So they've more than tripled. Yet, if you look at Twitter, they're down almost 40% since going public. So what's the difference between Twitter and Facebook? Well, it's the ability to monetize their business model and make revenue. Will Snapchat be able to do that? I've seen pluses and minuses. But just as a thought here, one thing you could do is, rather than buying options on Snapchat, because those have the decaying effect unless you're willing to go in and buy 80 plus delta out 6 months, I'd give it a year, maybe pick up 200-300 shares of stock, even at $14 to $16 a share, and then just sit on it and then see what it does. If you're lucky, and no one can predict this, but if their revenue model works, they can end up doubling and tripling over a year or two. And it wouldn't be hard to do from a $14 or a $15 share IPO price. You can make some money on it, and you buy just a little bit so it doesn't hurt you if just feel like you could just take that money and, I don't want to use the term throw it away, but it's just a little bit of play money to have fun with Snapchat. Who knows how that thing's going to play itself out, but that's going public this week. All right, everybody, have a really good one. For those of you that are in our user group, I will see you Sunday night on our weekly market watch. For those of you that are not, I highly encourage you to come in and take the offer in the email, because I think you'll enjoy what we're doing. We're 10 for 10 right now. We got some other trades we just put on this Friday. So hopefully you guys like what you see, and I will see you on the inside. Have a really great weekend, everybody. Take care, and members, I'll see you guys Sunday night. Have a good one, everybody. Ciao.